I am going to introduce you to a new and unusual trading system that I developed. It is unusual because it is based on putting on a pair of trades that you would think pointless. Furthermore, the strategy does not rely on choosing the correct market direction. In spite of these facts, this strategy will make a good profit a high percentage of the time. It generates exceptional annual returns. You will see our remarkable testing results. Counter Condor does not employ any parameters. Consequently, our unusual results have not been produced by means of optimization. This strategy is for sophisticated traders, although it can be auto-traded. It requires using options in a fashion similar to iron condors. The strategy is called the Counter Condor. I chose this name because in many ways it is the opposite of the iron condor. We are going to look at what happens when you trade leveraged ETFs simultaneously with their inverses. Here are two examples. At the top are two ETFs which are 3 times leveraged for the Russell 2000, TNA and TZA. One is the inverse of the other. Below are two similar ETFs representing the NASDAQ 100. They are leveraged 2 times. If on a given day you had bought both TNA and TZA, at the end of the day, you would expect to have neither a profit nor a loss. The same applies to QLD and QID. If these pairs were constructed correctly, their charts would be symmetric about the zero axis. It would look like a Rorschach. But that is not the case. Their center line falls at a rate of about 4% per month. This is where my journey began. I wanted to see if I could take advantage of this phenomenon. I began attacking the problem by testing if options might work. The first two conditions listed here imply each trade will last about a month. Thinkorswim uses actual trade data in its back testing. Theoretical data was not used in these tests. Here we are employing two spreads, each in the same direction, but they will be on the paired ETFs facing in opposite directions. These spreads will be just out of the money. They will have a low probability of success. However, as one of these loses value, the other gains. Because of their low probability, we benefit because each has a very good reward to risk ratio. Let's look at the results. Each bar represents one trade per month with an average gain per trade substantially over 25%. Money management. Option traders must be prepared to lose their entire cost of their trade when they put it on. Although we want our equity to grow, we want to keep the equity at risk minimal. With counter condor, you can do that. Let's go through our example. We are only going to risk 10% of our account by allocating $10,000 to each trade. Reviewing our data, this produces hardly any drawdown. With an average gain over 35% per trade, the account realizes an expected 42% growth per year without any compounding. Whenever a counter condor trade is considered, both the risk and reward are known. The potential reward is shown by the height of the wings in this chart. In this example, the wings, represented in green, are showing a potential 25% trade gain. It allows us to decide if the trade will be worthwhile. It also helps us to deal with the bid-ask differences in each of the spreads. I've been able to extend the counter condor strategy to trade pairs of correlated ETFs. The extension of the counter condor increases the number of trade combinations available each month. This allows us to identify the pairs trades with the best reward to risk potential and the greatest liquidity. This chart was generated from the trades of the extension of the counter condor. In spite of the big drawdown shown in its chart, restricting your investment to only 10% of your capital reduces the drawdown to 10%. Proof of this money management is shown by the annual rate of return and Sharpe ratio for your account. The annual rate of return here is over 60%. The Sharpe ratio is just below 2. It's 1.98. While the risk would double, placing two pairs trades, each risking 10% of the equity, we should expect the annual rate of return to more or less double. Therefore, we expect the Sharpe ratio to double as well. The risk is being distributed. The next to last slide showed some 100% losing trades. These could have been avoided by either buying a condor to offset the risk or by rolling the trade into the next month. If it's the week of expiration and the price of TNA or TZA is between its spread strikes, the risk can be neutralized with a long condor. This is a credit trade. TNA and TZA are both leveraged ETFs of IWM, which represents the Russell 2000. In this case, because of the liquidity, the IWM condor could be used. This repair strategy assumes that the price of IWM will not have moved much at expiration, which is only a few days away. There are many reasons why counter condor is so attractive. We don't care if the market is going up or down, whether there is war or Congress passes a good budget. Because of the high pairs correlation, the leverage, and the one-point strike spreads, probability is in our favor. We know the risk and reward of each trade in advance. Once a trade is placed, we can just relax. Come to my website, grab the cash and dash, and let me show you how to trade profitably. Thank you for watching this video.